Hello everyone. I'm sending out this, putting out this video because I've just graded your assignments 3 and 4, and I wanted to clarify a few things. So first of all, we have our meeting scheduled to go over the investment fund on Friday morning. I've made, on most of yours, I've made some suggestions, small things to change. I need you, and so for your group grade, so there's a group project grade as well for the class. One thing I'm going to ask you to do is to fix a couple mistakes that I had in the workbook, and then consider making those changes that I suggested in the feedback to you. And I'm going to talk a little bit about that too, because there was a consistent item for almost everyone. A few people don't need to change what they had there, but you might consider that as well. I'm going to go over that here in a minute. But I made 2 mistakes in the workbook that I'd like you to fix. And some of you did fix one of them. And then the other one, nobody fixed, and I didn't realize that it was a mistake until I was through grading most of them. So it didn't have a big impact on the final numbers, but it did have an impact for some of the companies. So the first thing where I made 2 mistakes in this workbook, and right now I've got the Southern Company pulled up because it actually worked pretty well for seeing these problems. Here's the problem. It was showing up as an error before, and that's why I didn't see it. So right here, I made a mistake. I didn't spell that right. The word is concatenate. Well, there's no T here, and so I don't know why it's showing a number in this field. Oh, well, I think it may have figured it out or something because it is highlighted here. But for some of you, there was an error term here because this is spelt wrong. So put a T in there, and you can see it actually changed the value. And so go ahead and make that change. That's on ROE on the DCF worksheet. So fix that concatenate. The last T was left out by me. And then the other item is on the weighted average cost of capital calculation. Okay, so the weighted average cost of capital calculation, I actually have it wrong on here. And I noticed this, and you might see here that the cost of equity in this case is 8.81%. Well, actually, it doesn't affect this one too much. But the way it's calculated up here is normally we take the weight of debt. Okay, so right here, or excuse me, the weight of equity multiplied by the cost of equity, so that's right up here. Then the weight of debt, right there, multiplied by the cost of debt, right there, multiplied by 1 minus the tax rate. But in this case, it's just the tax rate. So please make sure to make this correction. Again, it's on the weighted average cost of capital page. Just right in here, put equals 1 minus the tax rate. Okay. And that's going to have some effects on, you can see here it didn't have a big effect on the ending weighted average cost of capital, but it will have some effects on your values, specifically on the free cash flow to the firm value, because that's the only valuation that you use the weighted average cost of capital for. But if you could make those 2 corrections, and then you might want to make some additional changes based on what I put in your feedback. And once you do that, what I'd like you to do is make those changes and then email those back to me, and I'm going to put those on a file in OneDrive and share it with the class. And what I'm asking for you to do is to make those changes by Wednesday evening, let's say 5 o'clock or so, and then on Wednesday evening I'll make sure that everyone's is out there. I'll just put them up as they come in, but then I'll give you a chance, a little bit to look through those. Friday morning we'll have our meeting, and we'll discuss, how you all want to change the holdings of the student investment fund. The way that I've because we can't do it in real time, we can't buy and sell in the real time. I essentially have to submit the request to the dean. So what I would recommend doing is saying, we want to decrease our holdings in maybe certain companies that we have, and then use the cash generated by that to purchase use all of it maybe to purchase all the cash generated by those sales to purchase these other stocks. But we can't be too specific on the amounts, but we can say, how we want in general. I can make it more specific when it actually happens, but in general, maybe we want to decrease the holdings in Microsoft to 8% of our fund, and then use the proceeds of that to purchase stock in another company. Okay, so maybe think about along those lines as you're thinking about the recommendations you would make. So make sure to make those changes in your spreadsheet, in your workbook, and send those back to me. And then if you need to update any of the answers to your questions, do that as well, please. So the other thing I want to talk about, and I have it as feedback in most of your for most of your assignments, and clearly it is not a problem with you. It is a problem with how I explained it, because I didn't do a very good job of explaining this. So I want to talk a little bit about this H model, which is the one we used for the valuations, and those values of T, G1, G2, and H, and how they fit along this model here. So I also want you to pay attention here to the phases of the firm. So growth phase, transition phase, and mature phase. And overall, y'all did a nice job on this, on saying this is the phase that the company is in, and here is why. And you gave great explanations for that. So how do these phases generally show up in this H model? So if a firm is in its growth phase, well, it's got a high growth rate. So we'd actually see it along this part of the H model. So what that means is that in the growth phase, I'm just going to put it up here, T should be greater than 0, because there's a time period left where they're going to grow at this high growth rate. G1 is that high growth rate. And then they're going to come down off that growth rate, and they could come down fast or they could come down slow, but you're going to determine that, and that H, so the transition period, is the length of time that they're going to go, that it's going to take them to go from the high growth rate to the low growth rate, or their mature phase. Okay, so this is the transition period, transition phase here. So H is the length. And then finally, they're going to go down to that G2. There is no time associated with G2, because G2 is that constant growth, the constant growth rate that's going to, in theory, continue on forever. So that's what we would expect to see for the growth phase. Your T should be greater than 0. Because that whatever that T is going to be the length, the remaining length of that high growth phase. For the transition phase, T is equal to 0. You're already out of that high growth phase, and you're in this transition period. So maybe, it's up to you where you are at in this transition period, but that growth rate, that high growth rate, is going to be where you are in terms of the growth rate on this line here, and the H is how long it's going to take you to go from that higher growth rate down to the low growth rate. But the idea here is that the company is transitioning, is transitioning at that time. So your G1 should be greater than G2. So H is greater than 0, because you're actually in that transition period. And then G1 is greater than G2. Okay. Finally, the mature phase. In this phase, T is equal to 0, H is equal to 0. Okay. T and H are equal to 0 because you're down here. You're already in this mature phase for the company. G1 is irrelevant. You can put a value in for that. It actually won't affect the value of the firm. And then G2, and I talked about this in my responses for many of you. What should that G2 be? So G2 should be around 3%, and it kind of depends on the company. So if you think that the company is going to grow a little faster than the economy for a long period of time, they can't do that indefinitely, but they can do it for a long period of time, well then make it a little bit higher than that 3%. I've worked on some research papers with some folks where we've estimated that long-term growth rate, and then what I was putting it together this video and the lecture that went along with this before, I calculated that out, the growth rate in the United States gross domestic product over several decades, and I got 3.16% on average, average annual growth. So that's kind of the growth rate of our economy. I'm going to come back to that here in a minute. But if you have a firm that you think you're looking at them and they are going, they're declining, so maybe you have a company where their product or their service is not seen as beneficial to society and people are stopping buying that. I don't want to be too specific, but people are reducing their use of their product, then that long-term growth rate might be less than 3%. It could possibly also be negative, but not by much. Okay, otherwise they're going to be in bankruptcy very, very quickly. So a few years ago, this would have been Coca-Cola. They actually did have a negative growth rate, or excuse me, not a negative growth rate, a growth rate of less than 3%. They were in decline, and what that means, if the growth rate of the firm is less than the growth rate of the economy over the long run, that means that the firm is losing its value relative to the overall economy. Okay, relative to the overall economy, if it's not growing by the rate of the overall economy. So for most firms, we expect the growth rate to be around 3%. And this was the most common thing, and I knew that I had not explained it well when I saw for most people putting down much higher growth rates than that, and that's really not sustainable in the long run. Let me explain why a little bit, but I'm just going to run through this really quick again. So we're using the modified H model. If a firm is in the growth phase, then it's up here in this timeline. Okay, and so T is the remaining time until it starts its transition period. If it is a transition phase, then it's within this part of the timeline. Okay? And the H is the amount of time you expect it to take to go from its current growth rate down to the constant growth rate. While it's in the transition period, the growth rate every year is declining from where it's at to down to the final low growth rate. And that mature phase, the firm is at this constant low growth rate. So let me explain why it can't be really much higher than 3% for that long-term growth rate. The economy, and I'm going to use as an example here for the economy. The economy is we'll estimate the size of that by the nominal GDP, and the nominal GDP grows on average a little bit more or a little bit less than 3% per year. And where that comes from is, and I'm talking about the United States. In other countries, and especially developing countries, there are times when it's growing much faster than that. Okay. But in mature economies, that's about the growth rate, and that comes from two sources. So here in the U.S., it comes from the rate of population growth, which is about 1% a year, and the rate of inflation, which is about 2% a year. So if you think about it, we're constantly making new customers in the United States, having kids and growing the number of people in our population, either by bringing people into the United States or bringing people having children. This isn't a biology class, so I'm not going to go into that. But we're growing the population, and also the rate of inflation increases the cost of things by about 2% a year. Not everything grows at that rate, but overall the cost of things increases over time by about 2%. So we combine those two numbers together, and that's where that 3% comes from. All right, so if a company is growing at a greater rate than that for a long period of time, for that constant growth, then the size of that firm is going to grow relative to the size of the economy. And eventually, that firm is going to become outsized, versus the economy, because it's going to be growing faster than the economy. So if you think of Walmart went public in 1972. They had a few stores before that, little 5 and dime stores. But they went public, and they actually grew rapidly for 20 years. So they had a long high growth rate period. They grew rapidly till about 1992, and then they slowed down some. And then they had some more growth when it came to adding groceries to their stores. They didn't really do that until the late 1990s. They didn't really get into that grocery store concept until then. But now they've clearly settled down. They're in that mature growth area now. And so that's as an example of a firm that can grow for a very long time at a high rate, but eventually it does have to, its growth is going to peak and start to decline and get into that lower growth rate. If not, honestly, the firm would overtake our economy. And so even, with Walmart, they actually sell a large portion of many consumer items. So, for example, personal healthcare items, groceries, things like that. Walmart sells a considerable amount of those products within a percentage of those products within the U.S., which actually became an issue for them, because if they stop selling some company's item, that can actually put that company into bankruptcy, and that became an issue for them and how they do business. So just something to keep in mind there. That's why we don't see long-term growth rates really much above that 3%. In reality, in some examples I give, I use a higher growth rate than that because we're just doing math. But in reality, maybe 4% is an upper bound for that in a very long period of time. So please keep that in mind as you take a look at your notes and the feedback that I gave you for your assignment. Please make those changes that I suggested, or their suggestions, so you don't have to make them. But the two things from the spreadsheet I do ask you to make, so we make sure we're looking at good numbers there. So what you turn into me will be part of, and please make sure to turn in at least the changes I asked for with the mistakes I made on the spreadsheet. But that's going to be part of your group work grade. And so what we're going to do, please send those to me by 5 o'clock on Wednesday. Email them to me. I'm going to upload them to OneDrive. I'll just make sure that you made at least those two corrections that I suggested. We'll meet at, I think it's 10. I need to double check. I sent you a invitation on Friday morning, and then we'll go through the investment fund. We'll make some decisions about that, and then I'll talk to you about your final exam. I actually hope to have that out before our meeting on Friday. This week I am focusing on writing all of the final exams, and so I'm going to put those out as I get those written. Let me know if you have any questions, or if you want to go over with me anything on your assignment. I'm happy to do that if anything was confusing. Some of these were tough companies to look at. The banks especially are really hard. They're difficult to value. And I'll be honest with you, I think y'all did a good job on those of you who did the banks. You recognized the challenges with them. You used, I am pretty sure everyone used dividend discount model. I think it's a good choice for those, especially for two of the banks. That's definitely a good choice. But if you have any questions, let me know. I hope you have a great week. I hope that you're staying well and safe, and I will talk to you later on this week.